Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to Small Cap Discoveries conference call. Today on our call, we have back CEO Brad Bourne from Firan Technology Group. Firan trades on the TSX exchange under the symbol FTG, and it also trades on the OTC under FTGFF. The company is currently trading at $3.56 with about 24 million shares outstanding. We're going to an $85 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Great to have Brad back. Brad, since the last time we spoke, your stock has done extremely well on the back of a fair bit of news, not only some acquisitions that you've put together, but also a pretty strong quarter, Q2, I believe it was. Great to have you here. Would love to get into some of the updates, but before we do that, why don't you just remind everybody what Firan is all about?
Sure. Thanks, Paul. So FTG is an aerospace and defense electronics company. Our focus is obviously the aerospace and defense market and only that market. And we have two product offerings. We do printed circuit boards only for aerospace and defense, and we do cockpit products, which obviously is also for aerospace and defense. That is our focus, and that is what we love to do. If you are willing, I will go through a handful of slides to give you a quick update, and then we can talk further.
Let's do it, yeah.
Okay, so quick disclaimer that there could be forward-looking information included in what I say, and certainly consider that and other information before making any investment decisions. Quick update on 2023, starting at the top level. Market demand remains strong in aerospace and in defense. Boeing and Airbus are both ramping their production rates. They both have record backlogs of aircraft, very strong demand. So that's driving commercial aerospace. On the defense side, geopolitical tensions are definitely driving defense demands, or defense spending in most countries is going up because of uncertainty in the world these days. Beyond that, more at the FTG level, we are winning some new programs and growing our market share. We've had some significant wins for us that we believe are going to be on the order of $5 to $10 million in incremental sales in 2024 and beyond. We're actually in development on some of that, in qualification, and actually even starting to ship a few pieces this year. So it's progressing well and should be a nice add to next year's revenue. We're also proactively increasing prices. There's certainly been cost increases in inflation in our supply chain. Our costs have gone up, but we have been able to pass that on and possibly pass it on with a little bit of a margin expansion in our pricing to our customers. We're also seeing some very urgent demand from some customers, which also creates pricing opportunities for us. So I'm pretty pleased with what the sales guys and the site general managers have been doing in terms of pricing this year across FTG. We continue to invest in the business, in our existing businesses, to ramp production, to improve technologies. We have been very successful in getting funding from the U.S. government, the Canadian government, Ontario governments in support of these investments. And it's much appreciated, but it certainly is making FTG a more capable, significant player ready to support future demands through these investments. Our challenge is our operations. Our operations are being strained by the ramp in demand. I think our operations guys are doing a great job, but it is really putting some stress on them. The rate of increase that we're seeing from our customers, the increased demand, and we're struggling to keep up, but that's a much better problem than we had over the last few years where there was less demand. And then lastly, but very importantly, we closed two acquisitions, closed them both on the same day. And the only reason it was on the same day, we needed U.S. government approval for the acquisitions, and they were being reviewed by one person, and he approved them both on April 28th. They closed a little bit later than our initial expectations, but they are closed. And so they were both part of FTG on FTG's results in May, which was the last month of our Q2. Quick financial summary. So what you see on the slide is Q1 results, Q2 results, and then the first half results, which combines the 2 quarters. You can see a significant ramp in sales from Q1 to Q2. That's the part I say is challenging my operations guys, but for sure they're stepping up. And within that, about 3.4 million of the ramp from Q1 to Q2 came from the acquisitions. The rest was organic growth. Net income, you can say it looks like it went down, but in reality, we had a huge gift from the U.S. government in Q1, which was the employee retention credits, which was a pandemic credit, but we got it this year, a little bit late, but we got it. So what's really more relevant is the adjusted net income. So in Q1, we made about $1 million. In Q2, we made $2.3 million for a total of 3.3 through the first half. So in that case, when you adjust out the government funding, you can see the increase in profitability from Q1 to Q2. And the same on EBITDA. There's EBITDA and adjusted EBITDA. The adjusted EBITDA takes out the government funding. So again, you can see we went from 3.2 million to 5.2 million Q1 to Q2, and a total of 8.4 million for the first half. And that's a great quarter for us, or a great half for us. Q2, that's what can happen at FTG when everything goes well. We had a great quarter. All the sites performed. Just really, really proud of how the team across the company put it together and made it happen in Q2. Looking forward, just a little bit of caution around Q3, and I say this every year, and I'm going to say it again this year. Q3 for us picks up the months of June, July, and August. It's the summer months. It is typically softer for us, not necessarily softer in demand, but we are a manufacturer. Production days matter to us. Because so many people take vacations during the summer, we estimate we lose about a week of production in the quarter, and 1 week on 13 is about 8%. So, we kind of start with a challenge of losing that amount of production activity in the quarter. For sure, this year our Q3 has less simulator product revenue versus Q2. Our simulator business for cockpit products, I love it. It's great, but it's lumpy, and so it comes in lumps. And so Q2 was a good quarter. Q3 there'll be less of it. Offsetting that, the acquisitions. The acquisitions will be part of FTG for the full 3 months in Q3, and so that will certainly help revenue. Canadian dollar strengthened a little bit. That's a bit of a headwind, and maybe it's an issue, maybe not. But our Aerospace Toronto facility is a unionized plant. The contract expires in August. We've had many contracts. We've got through them all successfully in the past, but you never know. So there is a contract that will, be in negotiation. I don't think it will be settled in August, but there is a little bit of risk around that. And then lastly, for sure unanticipated that we had kind of key operations guy at our new facility we just acquired in Circus, Minnetonka. He had some health issues. He went home. He has not come back. I was very nervous about it. Good news is we have now put some new improved operations management in place in August, and these are some world-class guys. One of them's worked for me in the past. He agreed to come back and help me, and so my worry is much mitigated through the addition of these couple guys. Looking forward into Q4, Q4 does not have the challenges around the vacation, so Q4 is typically stronger for us. I think we're going to see some increased shipments of these new assemblies and new wins I talked about. Maybe not at the full production rates, but it'll be starting to ramp up in Q4. I think we're going to see some benefit from our pricing activities, pricing initiatives. And again, we'll have the acquisitions in FTG for the full 3 months, which will definitely be an add to the top line. And with any luck, we will have it ramp their production, and it will be an increased add to the top line. This is important to me. This is how I try to position the different sites. So that the 2 in yellow are the 2 new sites. We acquired Holiday Circuits, now called FTG Circuits Minnetonka. We're not the most creative guys with our naming, but they're in Minnetonka, Minnesota. But the thing that's important for me is that they're very similar plant to my Circuits Toronto plant, do high technology circuit boards. Both plants, very similar capabilities, but the one in Minnetonka is in the US, and therefore it can address the defense market better than the site I have in Toronto. And being able to address the high technology circuit boards for the defense market has been something that was a bit of a struggle for us historically. We have solved that. And then the other one, IMI Inc., now called FTG Circuits Haverhill. Again, our creative naming, they're in Haverhill, Massachusetts. A smaller site, but their focus is RF technology. RF is an important market in the defense side of the business, important product a lot of our customers buy. We had limited capabilities to offer that. This is all they do. And so I think it's gonna be a great add for FTG. And both of them help just fill out our product offering to our customers. Touch on IMI. I'm not going to go through all of this stuff, but I've already talked about the initial part, what their market focus is, what they're focused on defense, focused on RF. We're going to operate it as is where it is. So that's good news. Integration is relatively straightforward. The current president's going to remain in place for a year, so I don't have to worry about any leadership in that site for a little while. We are planning a little bit of incremental Capex just to add a little bit of capacity, add a little bit of capability, because they were definitely capital constrained before we acquired them. I think that's really going to open up some opportunities for them. And probably most importantly, they had virtually no sales staff, and we are unleashing our sales team to sell their capabilities. And I know that will, in time, drive their revenues up significantly. I'm very excited about this. You can see in my estimates, I'm saying in 24, I'm not really looking for a change from where they were in 22. But it always, excuse me, it takes time to really add revenue and to add customers in the defense market. So it's not going to be an overnight activity, but a little bit longer term than that, we'll start to see some real ramp in revenues. I'm confident of that. On the Holiday side, again, they're focused on high-tech circuit boards. They were doing over 31 million in 2019 pre-pandemic. They dropped into the low 20s during the pandemic. We're gonna ramp them back to where they were and hopefully beyond. It's going to take a little bit of time to do that for sure, but that is the objective. There's also some opportunities to take some cost out of their supply chain. They're now part of a bigger organization. We definitely have better pricing on some materials than what they had, so we're going to take advantage of that. That will take a few quarters to make happen. As I said earlier, the current management was to remain in place. I had that challenge around the operational leadership guy that went home, but my interim solution is implemented, and I'm feeling very comfortable about that going forward from August forward. I think they had done a less good job than us in adjusting their pricing to offset price increases in their supply chain. So we are working with them to get more aggressive on pricing, which will help long term. And they too really did not have a substantial sales team. So my sales team in the US is dying to be able to sell the capabilities of the site in Minnetonka and add some new customers into them. Again, that doesn't happen overnight, but it is something that for sure we are going to make happen. And again, just if I look at the financials, a very summary level. So 2019 was pre-pandemic, 31 million in sales and 4 million EBITDA. 22, they dropped to 23 million in sales. They actually lost some money, but for sure in their financials in that year, they included a bunch of their deal costs in terms of selling the company. 24, I don't think I'm going to be back to pre-pandemic levels, but I'm hoping to get them back into the high 20s in terms of revenue, and therefore, kind of into the $3 to $4 million EBITDA level for next year. Overall, again, just a quick summary. So 2019 had been my best year. That was pre-pandemic, 112 million in sales, 14.6 million in EBITDA. As I look forward to 24, I am expecting with the acquisitions, with some of the growth I talked about, our sales will be in the 140 to 160 million range, and EBITDA would be in the $20 million range. And that would certainly be a new record for FTG, and I'm certainly looking forward to making that happen next year. So it's a quick summary. Our markets are strong, our markets are robust. We're investing in our operations, in our technology. We're investing in growth. You know, we've completed the acquisitions. We're improving our financial performance. And, you know, right now my focus is mostly on making sure our new acquisitions are integrated and become, you know, important contributing parts to FTG. That is my quick summary.
Perfect. Thank you so much, Brad. Reminder to everybody that's listening, if you've got a question you'd like me to ask Brad, use the chat function, and then I'll relay that question out there. Brad, let's jump into Q2. Just a few details there, but you know, outstanding 52% growth in revenues for the quarter. Let's break it down a little bit more. What drove that increase, apart from, you know, a little bit of revenue coming in from the acquisitions? What really drove that Q2 strength?
Yeah, and you know, for sure it starts with just the overall market demand. Our customers ramped their demand significantly. You know, they probably ramped more than what we grew because we could not keep up. And you know, again, the growth, I'd say the growth was primarily in the commercial aerospace market, the Boeings and Airbus, that type of product. But defense remains strong, again, for the reasons I said, that just geopolitical tensions, you know, best example, obviously, what's going on in Ukraine, that defense spending is going up almost around the world these days. And, you know, that demand is driving, or that those things are driving demand to us. And then as fast as I can ramp production, I can ramp my revenues. I would say, just, sorry to add one more thing on that, that although I talked a lot about, you know, our success and in increasing prices, I would say price increases were not that significant in driving revenues in Q2. And the reason I say that, it takes time for those to roll through. So, you know, if we get a customer to agree to a price increase in February, I will have it, but I'll see the benefit of that when I start shipping that product, and that could be 3 to 6 months later. So the benefit of price increases is still to come in terms of future quarter performance.
Gotcha. And then as far as the input prices, you talked about some potential sort of labor costs increasing, but where else, if anywhere, are you seeing pressures on pricing of, you know, material or anything else you have to input here?
Yeah, for sure we're seeing on both sides. I'd say we're probably doing a better job of managing cost increases on the labor side. And, you know, but there's definitely some, and we're being fair to our employees. And so increases are higher than they had been historically, but I'd say our wage increase probably is averaging in the 3 to 5% range on an annualized basis, maybe closer to 5%. Material increases are more substantial, and it really is almost component by component. You know, we've seen some things that are up 1,000%. But, you know, I'd say material increases are probably averaging between, I don't know, 8 to maybe at the top end 15%. So they're pretty significant material increases, but we are definitely factoring that into any price adjustments we are passing on to our customers.
And I mean, are you seeing any more supply chain issues? I mean, we were hearing so much about that a while ago. What's it like now?
There's definitely some, but it's not as bad as it was. And, you know, we're seeing, I can say maybe more on the military side for some reason, but lead times are extended. You have to plan for that. If a connector used to be 20-week lead time, you know, it might be 40 weeks now. But I think we're all adjusting to that, and therefore we're just getting parts on order sooner, or, you know, extending our lead times to customers. And, you know, eventually we still get the parts in and we get them out the door.
Now, I also noticed, I mean, a decent jump in gross margins. What you know, we talked about a few of the input costs, but what if anything else drove those gross margin improvements?
Yeah, a few different things. You know, one, I talked about my simulator business. I love the simulator business. It's lumpy. It's also got some good margins,
Mm.
maybe a little bit higher, not crazy high, but a little bit higher than some of the other parts of my business. So that definitely helps my overall gross margin. The biggest one I would say is we're a manufacturer, and plant utilization has a big impact on profitability. And so if my utilization goes up, my fixed costs for all the plant and equipment and utilities and that does not change very much. And so my estimates, about 30% of my costs are fixed. Those costs don't change as the revenue goes up. So that 30% cost really kind of drops to the bottom line on any incremental revenue. And that really helps my profitability.
And you mentioned utilization then, but at the same time, you've got sort of labor seems to be kind of the bottleneck, if anything. Can you, how easy can you increase capacity sort of as is right now?
Yeah, it's not easy. But you know, I think again, the guys running my sites have been doing a pretty good job. Labor is one constraint in being able to add people. Hiring is tougher than it used to be, but it's not impossible. Certainly at the production level, at production operator level, we're doing more hiring using agencies, and they can get you candidates in a day. And so that helps. They're not necessarily always the best candidate, but they're hired on a contract basis. If they look like they're going to work out, we keep them and convert them to full-time employees. If they aren't working out, then it's easier for us to trade them out and move on to someone better. But we're definitely using agencies with some pretty good success at that level of hiring. At higher levels, in the engineering level, it's more of a standard recruiting process. And it's what we've always done. We've had reasonable success. Probably takes a little bit longer than it used to, but we eventually get the people we need.
Yeah, and apart from the things we just mentioned, mostly labor, what other challenges are you facing right now?
Really, it is keeping up with the demand, and it's well, as we talked about, there's a little bit on supply chain in terms of lead times primarily. So we're managing that, adding the labor to be able to ramp production, and just supporting some of this new work as well. New work puts more tasks our engineering effort a little bit more, but it also we're building prototypes, we're building qualification units. That also impacts production because it's not a steady state production run where we have everything dialed in. We are figuring out the best way to make some of these parts, and it's certainly less efficient at the beginning as opposed to a part we've been making for a few years. So that's been a challenge, but again, I love that challenge because if I'm winning new work, I'm happy to put up with a little bit of inefficiency while I get ready for 20 years of ongoing production.
Yeah, good problems to have, right?
Right.
So you mentioned in one of your slides you're expecting like a $5 to $10 million improvement in revenues. Give us a sense of what kind of visibility you have in this business. What does the future look like in terms of revenues and business?
Yeah, and my favorite thing that I look at to try to understand what the future looks like is on the commercial aerospace. On the commercial aerospace side, it's the big guys, and they publish it in the press. I mean, they certainly publish it and talk about it in the industry, but Boeing and Airbus, announced their production rates for this year. They announced when they're going to increase them, how much they're going to increase them by. They announced their target production rates for next year. And so we can have a couple of year outlook as to what they are expecting to do, and it takes them a long time to adjust their production rates. So we're not going to get surprised by it. They're not going to say today I'm going to ramp the 737 production from 31 aircraft a month to 38, and tomorrow they're going to have a different number. When they announce they're trying to ramp from 31 aircraft a month to 38, that's the number. And that's the number that they're aiming at for the next 6 months with no change. So a lot of confidence in that. It's makes it easy to forecast. There's little perturbations within their numbers, but it's nothing material.
Brad, give me a sense, like when we think of an airplane, how much of your stuff gets into an airplane? Maybe you can talk about it in terms of what it is and maybe dollar value.
Yeah, and it's all over the map.
Mm.
To be fair, and it
Sure.
depends what we're doing. If it's cockpit products versus circuit boards. Circuit boards are harder to track because they might go into an avionics unit that's used on various aircraft, and so a little bit tougher to give you numbers on that. But on the 787, the Boeing 787, I only do circuit boards. I don't do any of their cockpit. Wish I did, but I don't. But on the circuit board side, I'm gonna do probably a couple of $1 million a year on 787 circuit boards, based on the production rates. On some other aircraft, my favorite aircraft, it's actually a military one, but this is my dream for what I want to do for every aircraft. So where Lockheed makes a C-130 transport plane. It's been in production forever. It's probably been in production at least 30 years. They don't make a ton of them. They make 30 or 40 a year, but they make them every year. But the reason I like it is I do almost all the cockpit panels in that aircraft. I do a lot of circuit boards that go into the avionics of that aircraft. I do simulator parts for that aircraft, for simulators. And so I'm selling everything I can sell onto that platform. And I just, love when I can get into that sort of situation. What does that add up to in a year? It bounces around a little bit, but it's probably, north of $5 million a year. And if I can do that on more aircraft, that just makes, FTG just really good. And then last example, different one, but it's one that's becoming interesting. So I won content 10 years ago on the C919 aircraft in China. So China's decided they're going to make their own single aisle aircraft. It's similar to a Boeing 737 in terms of size. But I love winning content when there's a new plane being developed, because that's your best chance to change your market share. So we won almost all the cockpit assemblies, so kind of high-end product in the cockpit. So my content per aircraft on that is about $50,000 per aircraft. It's just entering production this year. They're going to build 20 planes this year, but their goal is to ramp it every year to get north of 150 planes a year. And so it's a long time coming. It was 10 years before they got that plane certified, but they have a very set production plan. It is it's in China, so it's managed by the central government. They set the production rates. They set it many years out, and they just work to it. And so, that's something where I love the content I have, and I love the certainty of their forecast.
Fantastic. You mentioned in one spot there a while ago about your capex. You're going to put in a little bit of capex, I think, in one of your acquisitions. But on an overall basis, what can we as investors sort of think of in terms of your capex plans, or say on an annual basis over the next several years?
Yeah, my target almost every year is approximately 3% of sales. And I say almost every year because this year, 2023, it's going to be more than 3% of sales. But, for a very specific reason. I said we've been, done a great job in getting funding from the US government, the Canadian government, Ontario government. But the Canadian Ontario funding is in support of investments to improve the business. And it can be capital, it can be R&D, it can be a number of things. But, because we're getting that support, we have ramped our investment plans for our 2 sites in Toronto through this year and part of next year to take advantage of the funding that's available. So, we will track for sure north of 3%. We might be closer to 5% this year because of the extra support we're getting.
I also noticed you got some sort of qualification. I think it says, my note says IPC 1791 qualification. What is that? And what does that do for your business?
Yeah, it's a good question. And it's actually, so it's the 3rd site now that we have certified IPC 1791. What it is, IPC is the Circuit Board Industry Association, or Electronic Assembly Industry Association. And the 1791 certification specifically is you are a trusted source for circuit boards or for assembly, trusted source for defense applications. They come in, they audit you, they audit all different aspects of your business, the security of the facility, cybersecurity, security of your supply chain, but it's all around security and secure source of supply. So when you're approved for that, it means, you know, you are set up and you have the controls in place to be a trusted source of supply for defense products. Interestingly, when I bought my facility in Virginia, they were one of the first sites in the world to be certified. And so that was my first one that's certified. When I bought IMI this year, they were already certified. And now I just certified my site in Toronto. So this is the first time I've actually had to go through the certification process. But for sure, I'm going to continue doing it until all FTG sites have that certification.
Awesome. Before we went on air here, we asked you a question around just the investor interest. The company now has grown a little bit, market cap's a little bit bigger. The share price has done exceedingly well over the course of the year. Are you seeing a heightened interest in the company from investors and institutions, analysts, all the powers that be out there?
We are, and it's good news and bad news. We're definitely seeing increased interest. I think the share price, as you talked about, just hits a number of flags for people that something's going on at this company. It must be something good because their share price is moving so much. But the other one, and some days I wish it wasn't the case, but anyone who runs a screen on stocks where it has a low multiple valuation, we make that screen. So notwithstanding our stock price has moved up, our enterprise value to EBITDA multiple is still a pretty low multiple. And so I regularly get people saying, hey, we came across this, you made our screen, can we talk to you? And so that's the other way we're definitely seeing more attention these days.
Gotcha. Now, I noticed that to somewhat fix that, you guys have an NCIB in place. So you guys are obviously looking at buying back stock if you see the right opportunity.
Yeah, and we had one last year, and we were active. It wasn't life changing, but last year we bought back about 500,000 shares through the year. So we definitely put a new NCIB in place for this year. To be fair, at this moment, our plan was get it in place so we have it available. And then, I wanted to wait a few months after the acquisitions just to make sure there's no surprises from the acquisitions, no, unexpected need of cash before we started to, look at an NCIB again. But we have the facility available. And so, yes, if it makes sense to us, we are ready to utilize it again this year.
Perfect. Now, I have to ask, I mean, you're a relatively young guy, but you've been doing this for a while. What do you see as the long-term sort of outlook here? What's the end game, if there is one?
Right. That's a very easy thing. There is no end game. I consider myself an employee. I certainly own, a significant number of shares, but most of them I went out and bought. But I am an employee. I'm hired to run the business. I'm going to work really hard to make FTG bigger and better every year. One day I'm going to go home, but that's not the end of FTG. Certainly that's not my hope. My hope is someone steps into my seat and continues FTG down the path to continue to make it bigger and better. So that's my plan. There is no exit strategy for me other than one day I go home and sit on the beach.
Attaboy. So the last couple of questions here, just in general, from our standpoint as investors, what do you think makes the most sense for us to pay attention to, like either metrics or potential catalysts? What should we watch for?
It's a good question. Again, utilization in my business matters. So if you see my top line moving, that almost gives certainty that the bottom line will improve. And so that's important, and obviously that's driven by market demand. So if you see aerospace and defense continue to be strong industries, then FTG should do well. risks are, for me, exchange rate. I'm certainly happy at the exchange rate we're at right now between the Canadian and US dollar. I'm becoming less exposed to exchange rate as I have more facilities in the US, but nevertheless, the movement in the exchange rate can help or hurt me. So it's something that people can pay attention to. And then again, just circle back to the acquisitions. I really need to make sure we integrate them properly, and then I take advantage of what FTG brings to them, either in terms of the sales team that can go sell their product and or get the material savings to take some cost out of the business. But if I can leverage those acquisitions, and that will just add to the overall performance of FTG, add to the top line, and add to EBITDA as well.
Now, Brad, did we miss anything? Is there any last minute things you want to say, or should we just sort of end with a key message?
Yeah, I think you asked a lot of very good questions. I can't think of anyone you didn't really ask. So really just, again, circle back to where I started. The market is strong. I see no reason for the market to weaken. Even if you believe there's going to be, some downturn in the economy, just the backlog at Boeing and Airbus are 7-8 years, and so they can withstand a downturn without reducing their production rates. So I think that the demand is there. And then so it's up to FTG. We need to continue to perform. We need to ramp our production. We need to integrate these acquisitions to get the full value out of them. And if we can do all of that, I think we can hit some pretty good numbers in the coming years.
Well, listen, congratulations on a fantastic year so far, and a couple of new acquisitions to bring the fold. Brad, we're actually going to see you in October, so I'm excited about that at the conference. But until then, I want to thank you for today's chance to talk, and certainly look forward to catching up as soon as we can.
Right. Okay. Thanks, Paul. Yes, I look forward to meeting you in person in October.
Awesome. Thank you so much.
Thanks.